Okay, students, we're back. Now, when the time ran out on me last time, I still had more I wanted to say about this problem, so I'm just going to go ahead and finish. Now, remember, what are we going to show on the statement of cash flows? Well, we're going to show the receipt of this cash, $380 million, which is a cash inflow from financing activity, because that's what borrowing money is a financing activity. So we received $380 million cash when we sold the bonds. That's what we report as a financing activity. Now, how much cash did we pay as interest? Well, $400 million face amount of the bonds times the face rate, 9%, times half a year. That's $18 million. So in the statement of cash flows, using the direct method, I'm going to show interest paid in cash of $18 million. Now you may be wondering, what happens to this $1 million amortization of the discount? Well, on the statement of cash flows, nothing happens to it this year because cash did not flow. Now, over the life of the bonds, this $20 million difference between what we sold the bonds for and their face amount represents the discount. And so over the life of the bonds, we're going to credit the discount. And remember, when we sold the bonds, what did we do? Debit cash for $380 million, debit discount on bonds payable for $20 million, credit bonds payable for $400 million. Right here. And from the problem, right here, face amount $400 million. So that's what we did when we sold the bonds. Now, over the life of the bonds, that $20 million discount is going to get amortized away, and it's going to show up in interest expense on the income statement, but it's not going to be reported on the statement of cash flows. Statement of cash flows is going to show the $18 million semi-annual interest payments in cash. Now, at the maturity of the bonds, we're going to have to pay back $400 million, the face amount of the bonds. So when we pay that $400 million, what we do is report $380 million of it as a cash outflow from financing activities, because that's the amount we really borrowed, $380 million. Now we're paying $400 million. So what happens to that other $20 million? Well, it goes into cash flow from operating activities as interest paid, because that's what it really is. We borrowed $380 million. We paid $18 million twice a year as interest payments in cash, and then on maturity we paid $400 million. That $20 million difference was just interest. So that's how we reported on the statement of cash flows. Now the next problem right here, refer to the situation described in brief exercise 21.5. What would be the amount related to the bonds that AGGI would report in its statement of cash flows for the year ended December 31, 2021, if it uses the indirect method? So up here we use the direct method. With the indirect method, the receipt of the $380 million is going to be handled exactly the same way. Cash inflow from financing activity, $380 million. Now, at the when it comes to the payment of the interest, remember, with the indirect method, we're starting with net income in the cash flow from operating activities section. And then we're having to reconcile to cash flow from operating activities. So what is the reconciling item between what was reported in net income and what was actually paid? Well, it's the amortization of the discount. So net income was reduced by $19 million interest expense, but we only paid $18 million in cash. So this $1 million amortization of the discount has got to be added back to net income to get to net cash flow from operating activities. So there you see the $380 million financing activities. The $1 million amortization of the discount would be added back to net income because the interest expense, $19 million, was subtracted in calculating net income, and yet the cash interest paid was only $18 million. Okay. Now let's move on to the next one. All right. Brief exercise 21.7. On January 1, 2021, the Merit Group issued to its bank a $41 million 5-year installment note to be paid in 5 equal payments at the end of each year. Installment payments of $10 million annually include interest at the rate of 7%. What would be the amounts related to the note that Merit would report in its statement of cash flows for the year ended December 31, 2021? Now, again, we're going to assume this is the direct method. And so we're going to show a cash inflow from financing activities for $41 million. Then the $10 million payment, well, how much was interest and how much was principal? Well, to get to that, we borrowed $41 million. We paid 7% interest. So to get to the interest amount, we need to multiply 7% times $41 million. And so when we do that, we get $2,870,000. Okay, that's the interest portion of the payment. So the interest portion of the payment is going to be reported as a cash flow, a cash outflow from operating activities. Now the remainder of the $10 million payment is reducing the loan balance. That's repayment of the loan. That is a financing activity. So we're going to show a cash inflow of $41 million from the borrowing, a cash and of financing activity from the borrowing. So a cash inflow of $41 million financing activity. And then we're going to show cash outflow of the interest, $2,870,000, as a cash outflow from an operating activity for payment of interest. And then the principal portion of the payment, which is the rest of the $10 million, cash outflow from financing activities. Okay. Now, what would happen to the distinction or the amount between interest and principal next year? Well, the interest amount would go down because it's $7 million, 7% times the outstanding balance. The outstanding balance is getting reduced by the repayment of principal right here. So next year, principal outstanding is going to be $41 million minus $7,130,000 times 7% to get to the interest expense. Okay, let's move on to brief exercise 21.8. Right here, on July 15, 2021, M.W. Morgan Distribution sold land for $35 million that it had purchased in 2016 for $22 million. What would be the amount related to the sale that Morgan would report in its statement of cash flows for the year ended December 31, 2021, using the direct method and then using the indirect method? Okay, with the direct method, pretty simple. They have a $35 million cash inflow from an investing activity for the sale of the land That's all they're going to have to report. Let's go ahead and I'll show you that. So Morgan would report the cash inflow of $35 million for the sale as a cash inflow from investing activities in its statement of cash flows. Now, the $13 million gain is not considered a cash flow. The cash flow is right here, the money from the sale, and so that would not be reported using the direct method. Now, with the indirect method, this $13 million gain, the difference between the $35 million they sold it for and the $22 million they had paid for it, that $13 million difference is a gain on the sale of the land. That went into the calculation of net income, but it's not an operating activity. The $13 million is part of the $35 million cash received that's being reported right here as an investing activity. So under the indirect method, we're going to have to subtract this $13 million gain out of net income to get to net cash flow from operating activities. So for that reason, when using the indirect method, the gain would be subtracted from net income, which includes the gain, to avoid double counting it. Yeah, if we had counted that $13 million in net income as a cash flow, we'd be putting it in here as an investing activity and then also as an operating activity. So for that reason, we have to subtract it out. Okay, let's move on to the next one. So we are right here on 9. Carter Containers sold marketable equity securities, land, and common stock for $30 million, $15 million, and $40 million, respectively. Carter also purchased treasury stock, equipment, and a patent for $21 million, $25 million, and $12 million, respectively. What amount should Carter report as net cash flow from investing activities? Well, the investing activities center around assets. So they sold marketable equity securities, so that's an investment. That is a cash inflow from an investing activity. They sold land, that is an investing activity. So the $30 million and the $15 million are cash inflows from investing activities. Sale of the common stock is a financing activity. So that one doesn't figure in here, that $40 million. Then Carter also purchased treasury stock. That's financing activity, doesn't factor in here, so that $21 million doesn't count. They purchased equipment for $25 million and a patent for $12 million. So those are both investing activities. So we're going to have inflows of $30 million and $15 million, and outflows of $25 million and $12 million. So whatever that nets out to. So there's the $30 million and the $15 million, the $25 and the $12. So nets out to net cash flows from investing activities for $8 million. Now, next question. They say, okay, look up here and what would be shown for financing activities. Well, the financing activities were a cash inflow from the sale of common stock of $40 million and a cash outflow for the purchase of treasury stock of $21 million, so a net cash inflow of $19 million. So there's the cash inflow from the sale of common shares and our own stock, and then the purchase of treasury stock, and that's a cash outflow. So that gets us to the $19 million net cash flows from financing activities. Okay, our time's about up. I'm going to end this video now, and then I will pick up right after this material.